So Bollinger envelopes are calculated using the highs and lows. There's no inclusion of either the open or the close, just the highs and the lows. The code is up there. It's a little bit more code, but you can see the result. What I do is I calculate 20-day volatility of the highs and the average of the highs, and I use that to project a band above the highs, and I calculate the 20-day volatility of the lows and the average of the lows, and I use that to project a band below. The default distance is 1.5, and that produces a result very similar in terms of the amount of data contained to standard Bollinger Bands. You can see in that code how it's done, and again, I'll give you the example so you can take it apart. But just so it's clear, because I know it's a lot, and we're moving along pretty quickly here. The upper Bollinger envelope is a 20-period average of the highs plus 1.5 times a 20-period standard deviation of the highs. And of course, that could be a 15-period or a 25-period or whatever you like, but 20 is my default. And for the lower band, it's a 20-day average of the lows minus 1.5 times the standard deviation of the lows. All right. So now you have a set of trading bands that makes no reference whatsoever to the open or close. Right. So these will work fabulously for something like Bitcoin, something that's traded around the clock. Increasingly, the big stocks in the world are traded, on multiple exchanges around the clock. And so you can now include that data and get rid of the opens and closes and get a better picture of the true global demand for equities.